Hello and welcome to our first investment outlook update of 2021. This year, to no one's surprise, is going to be dominated by the evolution of COVID. We're now in a race between the spread of the virus and the vaccination process. But let's be clear, it's a race that there's every reason to win. So we expect 2021 to be a year of economic catch-up, with a challenging first quarter as many countries will still have to deal with stringent COVID measures. There are several reasons for this. First, economic activity looks now more resilient to the shock of COVID. Recent macroeconomic data, including global manufacturing numbers, high-frequency activity data, employment, and corporate defaults are all holding up better than feared. What's more, governments are committed to deep fiscal support, especially in the US, with much larger expected plans. This will continue to cushion the shocks and should be enough to avoid another severe contraction. Could it lead to higher inflation? Well, high consumer savings, recovering demands mean that yes, inflation should normalize to a certain extent, but not enough to force central bank to tighten rates this year. We're still in a low inflation world with significant job market slack, and central banks led by the Fed are softening their inflation targets. Overall, we expect consumption, housing, and trade to drive the recovery this year. This will benefit emerging markets, especially as financial conditions remain supportive, and the Biden administration is likely to prove a more predictable trade partner. So how are we investing our clients' portfolios to benefit? Well, let's hear from Stéphane.
Markets have shifted into a new gear after the historic challenges of last year. The new economic and geopolitical dynamics are supportive for risk assets and make us cautiously optimistic as we begin 2021. We see a number of ways to invest in the business recovery as vaccination campaigns roll out. Let's look first at equities. European and emerging stock markets, as well as small capitalization names, should all perform well in this improving business cycle and benefit from stronger global trade. In terms of sectors, we are increasing our allocation to industrials, materials, financials, and energy, while keeping exposure to strong longer-term trends in quality growth such as technology and healthcare stocks. In fixed income, we have reduced our holdings of government bonds and investment-grade credit on potential for higher real yields in the coming months. We see better yield opportunities as well as some portfolio hedging through Chinese bonds, where we have increased our allocation. The positive outlook for the yuan also boosts the case for investing in Chinese debt. As we expect the US dollar to continue its path of decline this year and see an improvement in global trade, several emerging currencies should also offer interesting opportunities. Overall, we fully expect that with the massive levels of government and central bank support that Samy just highlighted, risk assets should weather the shock of COVID. This can only be reinforced with even more generous fiscal stimulus in the US as the world's biggest superpower engages in a pivotal shift for its economy and its role in the world under Joe Biden's leadership. Our global outlook does not mean the investment path will be smooth. That's why investors need to stay strongly diversified and prudent, ready to seize opportunities and hedge their portfolios whenever necessary. Thank you very much for watching and our very best wishes for the new year.